Hey there, I've got a question for you. What if I told you that something as small as $20 a day could realistically grow into $500,000? I know what you're thinking. That sounds like one of those internet finance myths, right? But stick with me for a few minutes, because today I'm going to break down the simple math behind how this can actually happen. No lottery wins, no secret investment tricks, just time, consistency, and a powerful financial principle that most people completely underestimate. And once you see the numbers, this thread gets really interesting. Because what we're really talking about here isn't just money. We're talking about how small daily decisions quietly shape your financial future. My name is Bill, and I spend way too much time thinking about personal finance strategies. And over the years, I've noticed something fascinating. Most people don't fail financially because they make one huge mistake. They fail because of tiny decisions repeated every single day. The extra takeout meal, the subscription they forgot about, the impulse purchase that didn't seem like a big deal. Individually, these things look harmless, but collectively, they quietly determine whether someone ends up financially stressed or financially secure. And here's the reality check. Nearly 70% of people don't even have $1,000 in savings. That's not because most people are irresponsible. It's because modern life makes it incredibly easy to spend money and incredibly difficult to think long-term. But here's what most people don't realize. Even a small daily habit, when invested consistently, can completely transform your financial future. So let's break down the math. Let's start with the basic numbers. Saving $20 per day equals $140 per week, about $600 per month, around $7,300 per year. Now, for many people, $20 doesn't sound like much. It's a couple of coffees, maybe a fast food meal, or a few small impulse purchases. But when that same $20 is invested instead of spent, something powerful happens. This is where compound interest enters the picture. Compound interest is basically when your money starts earning money, and then that money starts earning even more money. Think of it like a snowball rolling down a hill. At first, the snowball grows slowly, but as it rolls further, it collects more snow, and suddenly it starts growing much faster. Investing works the same way. Let's assume you invest $20 every day, and your investments grow at an average rate of 10% per year, which is close to the historical average of the stock market. After 10 years, your investments could grow to around $116,000. After 20 years, that amount grows to roughly $458,000. And after about 21 years, you cross $500,000. Now, here's what most people don't realize. You didn't personally save $500,000. You only contributed around $153,000. The remaining $350,000 plus came from investment growth. That's the power of compounding. And this thread gets really interesting when you realize something important. The longer your money stays invested, the less work you have to do. Now you might be thinking, Bill, if it's really this simple, why doesn't everyone do it? And that's a great question. Because the biggest obstacle here isn't math, it's human psychology. Humans are wired for instant gratification. A $20 purchase today feels small and harmless, but our brains don't naturally calculate the future value of that money. For example, if you spend $20 today, you lose $20. But if you invest $20 and let it grow for 20 years, that same money might become $120 or more. So the real cost of that purchase wasn't $20, it might have been $120 of future wealth. And once you start thinking this way, your perspective on spending changes dramatically. Let me give you a quick example. A friend of mine once told me he couldn't save any money. He believed his income simply wasn't high enough. So I suggested something simple. Track every expense for 1 month. At the end of the month, he was shocked. Coffee purchases, $170. Food delivery, $230. Random online purchases, $140. Subscriptions he barely used, $95. Total unnecessary spending, about $635 per month. That's basically $20 per day. None of those purchases felt large at the time, but together they represented the exact amount that could have been invested. This is the hidden force behind most financial struggles. Not one big mistake, just small habits repeated daily. So how do you actually start applying this idea? Let's make it simple. Step 1. Track your spending for 30 days. You don't need complicated apps, just write down every purchase. Most people quickly discover $10 to $30 per day they could easily redirect. Step 2. Automate your investing. Automation is incredibly powerful. Set up an automatic transfer of about $600 per month into an investment account. Once it's automatic, you remove the temptation to spend that money. Step 3. Invest consistently. You don't need complex strategies. Many successful investors simply invest in broad market index funds that grow alongside the overall economy. Step 4. Ignore short-term market noise. Markets go up, markets go down, but over long periods, they historically trend upward. Consistency matters far more than perfect timing. Now, here's the important insight. The real goal of building wealth isn't just money. It's freedom. Freedom to work less. Freedom to pursue opportunities. Freedom to help your family. Freedom to design your life on your own terms. And $500,000 represents something powerful. Options. So the real question isn't whether $20 per day can become $500,000. The math clearly shows that it can. The real question is this: what small habit today could quietly turn into $500,000 tomorrow? If this video helped you think differently about money, make sure to subscribe and hit the like button. Thanks for watching, and I'll see you in the next video. And remember, small habits create big results.